Is Warren Buffett preparing for a market crash? Today, I'm going to show you exactly why he's dumping Apple shares to buy Google and what this great market rotation from AI to defensive stocks means for your money. This isn't just about big tech. The crypto market is in freefall, and legendary investors are warning of a lost decade for stocks. Stay with me because I'll reveal the specific, undervalued companies that could be the big winners of this shift. Let's start with the big news. For the fifth quarter in a row, Berkshire Hathaway has reduced its stake in Apple. At the same time, Buffett has been buying Alphabet, or Google. This isn't random, it's a clear signal. Buffett is moving into a defensive posture. He's trimming his position in a company highly dependent on consumer spending and moving into a digital fortress with some of the best competitive advantages on the planet. Google's high margins and predictable business make it a safer harbor in a stormy market. And he's not alone in his caution. Howard Marks is warning that the S&P 500 is so overvalued, we could be looking at a lost decade with returns of 0 to 2% per year. Think about that, a whole decade of going nowhere. We also see Bill Gates selling a huge chunk of his Microsoft shares. Peter Thiel, one of the earliest investors in Silicon Valley, sold his entire NVIDIA stake. Ray Dalio is selling his AI-related stocks too. When the smartest people in the room are all quietly heading for the exits, you need to pay attention. They see the excessive leverage and high valuations, especially in tech, and are preparing for a downturn. If you want to stay ahead of these market shifts, make sure you subscribe to the channel so you don't miss these critical updates. Now, let's talk about the two areas where the speculation has been wildest: AI and crypto. The AI narrative has pushed some stocks to insane levels. NVIDIA's upcoming earnings report is a massive event for the entire market. If they show any signs of weakness, the entire AI sector could take a hit. Stocks like Palantir and AMD are trading at extremely high multiples, pricing in perfection that may never come. But this AI hype creates opportunities. Look at Adobe. Its stock has been punished because the market fears AI will destroy its business. But if you look at their numbers, the fundamentals are as strong as ever. Growth is stable, margins are high. This is a classic case of market fear creating a discount on a high-quality company. Then there's crypto. We are seeing a massive liquidation. The gap between large caps like Bitcoin and the smaller altcoins is widening as the market panics. My forecast here is bearish. I believe Bitcoin and Ethereum still have further to fall. If you're not already in crypto, this is not the time to jump in. The risk of getting burned is just too high. This brings us to where the opportunities are. We've talked about Adobe, but there are entire sectors being ignored by the market. And later, I'll tell you about a specific royalty company in the energy sector that looks incredibly cheap. The clear trend right now is a rotation from AI into defensive sectors. A defensive company is one that sells goods or services people need, regardless of the economy. This is especially important because consumer spending is showing signs of cracking. That's a huge red flag for high-flying restaurant stocks like Chipotle. Its valuation no longer makes sense if consumer growth is slowing down. You'd be much safer in a company like McDonald's, which is more resilient. So where can you find value? First, let's look at that energy company I mentioned, Viper Energy. It's a royalty company, which is a key distinction. That means they get a percentage of the revenue from oil extracted on their land without having to pay for the expensive drilling and operations. This results in incredibly high margins, low debt, and an attractive dividend. It's a smart way to get exposure to energy with less risk. We're also seeing great opportunities in Europe, where many high-quality companies are trading at a discount. Look at Sodexo, a food services and facilities management company. It's significantly undervalued compared to its peers and has a business model that has historically performed very well during economic downturns. Another one is Teleperformance. The market has punished it for a minor slowdown in growth and AI fears, and it's now trading at very low multiples. But the business is stable and the dividend is sustainable. This is an overreaction you can take advantage of. Finally, for a bit of geographic diversification, the Japan ETF is interesting. Yes, their economy just contracted, but this often leads to government stimulus. Looking for opportunities to buy this ETF on pullbacks could be a wise long-term strategy. To recap, the smart money is getting defensive. The AI and crypto bubbles look fragile. Real, durable value is found in overlooked, fundamentally strong companies in resilient sectors. It's a tricky market, but there are always opportunities if you know where to look. If you got value from this video, hit that subscribe button to join our community of smart investors. What do you think of Buffett's move? Are you buying Google or selling Apple? Let me know in the comments below.